Hey, what's going on, everybody? It is Aaron Trevino here, and we have a terrific guest. We have Travis down in Florida. How you doing, Travis?
Hey, Aaron, doing great. Thanks for having me.
Absolutely. I know we've had this in the works for a little bit, so it's great to see you and great to have you on the show.
Yeah, man. Thanks for reaching out.
Okay, absolutely. So for those of us who aren't familiar, would you introduce yourself?
Sure. Yeah. I guess a lot of people know me as kind of the multifamily guy, the apartment investor. But, at the end of the day, what I'm really about is just helping people along their own financial independence journey, whatever that means for them, whether it's retirement or early retirement or just building, cash flow and passive income streams. So that's really what my passion is. I do a multitude of things. I do free mentorships on 15-minute Q&A calls with folks. Post a lot of blogs and content out there to the world. I'm director of investor relations at Ashcroft Capital. So we're a multifamily apartment syndication firm doing deals mostly in the South. And so that's for accredited investors and 506C deals. But yeah, man, I don't know. Where do you want to take it from here? I could go on forever.
Yeah, absolutely. So you said Ashcroft Capital, right?
Correct. Yep.
Okay, very good. So I'm just curious, about, have you always been in real estate, or how did you kind of get into this line of work?
Yeah, I got involved with single family home investing, just more of a buy and hold strategy in 2009, just out of college. And I started with house hacking, renting out a spare bedroom. That was my first eye opener to real estate and this idea of passive income, right? I had a mortgage that was like, I don't know, $640. And I had a roommate giving me a check for $600. And I thought, hey, that's pretty cool. I'm basically living for free right out of college. So that kind of got the ball rolling. Of course, I read all the Kiyosaki books and I went down the rabbit hole like a lot of people do with that stuff. And that was great. Helped me build the foundation out. And I did fix and flips for a while. I did vacation rentals for a while. And all the while, I should point out, I was working a very intense W-2 job in the oil industry. By intense, I mean consistent 14-hour days, 98-hour work weeks. And I was out of state, away from home, overseas. I worked in Saudi Arabia. So as I'm trying to scale up this active real estate stuff, as you can imagine, it's a bit of a recipe for disaster. At least it was for me. So I did that for about 6 years and I burned out. And I thought, holy crap. I wanted to get to 100 single family homes and I'm not even 20% of the way there. And I'm burned, in my 20s. So I had to find a way to be more hands off, and that's what led me to, I've done note lending as well. I still do that actually in a multitude of facets. And then primarily, I'm invested in apartment syndications nationwide with various groups, obviously with Ashcroft Capital, but with many others as well. At the end of the day, I'm looking for risk-adjusted returns with a cash flow focus, and that's really it, and helping people do the same. Mostly, doctors, dentist, lawyer, attorney, pro athlete, business owner, entrepreneur, people who are busy. They don't have the time to be flipping properties, nor do they really want to do that, but they do enjoy real estate and what it has to offer and the tax advantages, the leverage, the cash flow, et cetera. So that's really kind of my world. And before COVID, I was going out to conferences, I was speaking at events, and I was helping people that way and networking in person. And since 2020, it's been all online, and now I'm all over Instagram and LinkedIn and Bigger Pockets and Facebook. And so it's been a big change in my world. I was never the online social media guy, but I guess I've kind of somewhat turned into that over the last year.
Yeah, absolutely. I'm just curious as well. You mentioned you were in Saudi Arabia. Were you doing, were you doing work kind of in the finance world, or something a bit unrelated?
Yeah, so this was the latter part of my oil field days. The reason I chose to go overseas is because they had an equal time off schedule. And a big part of my purpose and mission and to the world to help people is about your time value, and I really wanted to work less and I really didn't want to work in that industry at all. Uh-huh. And so I was doing a safety program for a very large oil company. Anyone familiar, there's only one oil company in Saudi Arabia, and that's Saudi Aramco. But I was with a US company contracting with them. So Wasn't my thing, wasn't my passion, paid quite well, lived kind of to the FIRE movement strategy. I was really pocketing a lot of cash, living well below my means, and parking it all into real estate back in the US. And so that's kind of how I got my jump start.
Yeah, absolutely. So it sounds like you've kind of had your hands in different parts of the industry, right? From kind of oil and gas to pocketing that and just feeding the real estate machine.
Yeah, it's kind of just to speak quickly on kind of the personal finance side of things. I was raised by two very frugal parents, and they taught me so much about using coupons, living below your means, buying the off brand, getting things on sale, not keeping up with the Joneses. They had a lot of solid foundational things that got instilled from a young age. What they never taught me, though, was anything about investing, because they were not investors themselves, at least not during my childhood. They are now, but they weren't then. And so this has all been a journey of self-education, and the 4-step strategy that I always point out that I use is really simple on paper, but not necessarily easy to do. It takes a lot of self-discipline, but it's basically earn as much income as you can earn using your highest and best earning potential. So for me, it was like flipping houses, oil field jobs, side hustles, whatever, that kind of stuff. And then live on as little as possible for a period of time, not for your whole life, but just, call it 5 or 10 years, just as an example. And then basically take the difference of what you're earning and what you're living on and invest that difference into something. For me, that was real estate and things that produce cash flow. That was really my thing. Other people do index funds or whatever. It's up to you. And then number 4 is just avoid bad debt, credit card debt, consumer debt, personal loans, student debt, whatever kind of debt you have, pay it off, get it over with, move forward. And really that was the strategy, and so my wife and I, we live humbly, it's not very extravagant. And, but, we're happy. We focus on the things that bring fulfillment into our lives. And the passive income has given us a lot of flexibility over lifestyle and over travel and things that we love to do. So that's kind of what the message is and what the purpose is. It's not really a money game. It's about your time and the freedom that can bring.
Yeah, absolutely. You touched on 2 important things, was not only the freedom that money can give you when managed properly, but also the time. Could you kind of, elaborate more on the relationship between time and money?
Yeah, exactly. So the reason that I pursued a path of the passive income approach rather than the active, of course, I did active early on, as I pointed out, but ultimately what became important was my time. Money you can get back, time you cannot. We all know this, right? And I'll share with you this. There's an interesting study or a survey done, and it was by a nurse. I think she was from Australia. Her name was Bronnie Ware. And so this is like around 2009 or so. And she worked with terminally ill patients in a patient care unit. And what she would do is she was just a personable person. She would talk to people, and a lot of people would share their top regrets in life with her. She decided to first make that a blog, then a book, then she became a speaker. Then she ended up quitting being a nurse to go pursue this and help people. But I just want to get right to the point. She wrote a book called the Top 5 Regrets of the Dying, but I'll give you the top 2. And I never pursued my dreams and aspirations. I didn't spend enough time with friends and family. So that really impacted me when I learned about that, and it really, you can just imagine how many people would resonate with that message and do resonate with that. So I thought, so how do you get to the point where you can pursue your dreams and aspirations and spend time with friends and family if that's your thing? Well, to me, the relationship, to answer your question, is when you have more passive income or cash flow or interest or dividends coming in every month or every quarter, and that exceeds your lifestyle expenses, your mortgage, your rent, your bills, your travel, your food, et cetera, you're financially independent, let's call it. It doesn't mean that you retire now. It just means that you have flexibility and choices that you otherwise may not have had. So for me, I wanted to leave the oil field job, and I was able to do that through cash flow, right? It gave me a backstop to where I could quit my job and didn't have to worry about losing my house, for example. Other people, want to pivot careers like that, want to switch to part-time work, want to become more charitable, do more volunteer things, spend more time with their kids, be a stay-at-home parent. you name it, list goes on and on. But to me, that's what the importance is. So it's not a money thing. It's not look how many dollars I have. It's about I have freedom and flexibility over my time, and I get to choose what I do with that. And to me, that's the biggest gift anybody could ever have. And that's my mission, is to help people achieve it.
Yeah, absolutely. It's interesting how they all kind of have these symbiotic relationships, the time with the money, with the lifestyle, with, how you're, able to kind of craft your own life.
Yeah, exactly. Yeah. So it's and I know I dropped the FIRE movement earlier, and some people may not be familiar. It's an acronym for financial independence, retire early. It gets a lot of controversy over the RE, right? Retire early. A lot of people give that heat, what are you supposed to do in your 30s? You can't retire. Well, it's not about retirement. It's just about creating a lifestyle design that suits you well, right? And it doesn't mean quit working necessarily. You might just start a blog, you might just be a traveling photographer, whatever. It doesn't mean that you're retired. It just means that's your highest and best use of what brings you fulfillment in life.
Yeah, that's an interesting distinction too, because if you hear, you'll see these headlines on the internet saying, oh, this guy's 35 and he's retired. And, people kind of scoff and say, oh, I don't want that. Right.
Right. Yeah. Common excuse. I don't want that. You don't have to have that. You don't have to mimic what that person does, but without a doubt, you do want options. And if you say you don't, you're lying, because you do. Everybody could use an option. And if you don't want the money yourself, give it away. Well, who doesn't want to be more charitable? You know what I mean? Give it to anybody. So it's, why not, is kind of my thought process. Why not pursue this stuff? The tragedy is, Aaron, that a lot of people get into their 60s and 70s, relying on the government, relying on a 401k, relying on a pension that may not be there, before they ever start the process of trying to learn passive investing, right? How do you take $1 million 401k that's in the stock market and start converting that into income? Pretty tough, right? Especially if you're trying to learn from scratch when you're 70 years old. So why not start learning it now? Then you have a plan. Then you know what to do. Even if you want to wait till you're 70 to retire, by all means, but you'll have a plan, right? You'll know what to do when the time comes. And so that's the whole thing, is we all have to get to a place, if we're going to retire ever, where we have to understand the fundamentals of living on income, right? Not just equity, not just day trading and flipping homes.
Yeah, absolutely. I'm just curious as well, in your opinion, what's the biggest issue in terms of the way people view money, or what's the biggest misconception that you think people have about it?
I would say there's still a lot of marketing and stigma tied to the old ways of, investing and going throughout your life. We all kind of know the old school system, that you're going to school and college degree, job, stay with that company long-term, have a pension, max out your 401k. All this kind of stuff sets you up for not having many options before you're 60, right? Because in a lot of these accounts, whether we're talking about a Roth or traditional IRA or 401k, you can't touch this stuff till you're 59 and a half without a penalty, and it's heavily taxed afterwards. So my whole thing that I thought about was, why don't I circumvent the system? Why don't I instead start focusing on investments that I can touch now, that I can benefit from now? I don't have to, I choose to, having, let's say, a brokerage account if I want to do the stock stuff. Well, I'm not penalized if I want to make a sale and take my profits off the table, or go buy a house with the funds, or live on the cash flow today in my 30s. This was kind of the thought process that got me evolving that direction. Took a lot to get there. I read books like Andy Tanner's 401 Chaos. I mentioned the Robert Kiyosaki books, Cash Flow Quadrant, Rich Dad, Poor Dad, etc. All of these help paint the foundation for this. Not solely those books, but, conversations with folks. And the more I thought about it, the more I thought, there's no guarantees in life. What if I pass away at 58? What a tragedy. And so I would love to just help people have the option to do what they want to do sooner than later. That's the whole purpose.
Yeah, absolutely. So in terms of those options, what are some good options do you think that people could have if they don't know exactly where to start?
Yeah. So again, at the very beginning here, I mentioned a lot of people know me as kind of the multifamily guy, the apartment investor, which is primarily what I park my money into today in 2021 and in 2020. But, ask me in 10 years, I'm not tied to this asset like it's the end all be all. If this market gets chased and chased and chased and the cap rates go down to 2% and my cash flow becomes a 3% yield, I'm no longer in it. I'm going to switch over to municipal bonds or something, something that's got a higher yield than this, because I'm taking too much risk for too little in return, So you have to be a little bit of a macro level research individual. You don't have to be an expert in everything. You can certainly utilize teams and advisors and whatnot, but just understand what's happening in the economy from a high level. Subscribe to newsletters, listen to podcasts, read books, etc. Find a mentor. But, to your point, what can people do? Focus, to me, what I do is I focus on income, dividends, interest, cash flow, not equity upside. I'm never trying to buy a stock at 10 and say, God, I hope that goes to 15. If it does, I'm going to sell and make a capital gain and pay taxes. I don't do that. I buy it at 10 and I could care less what the price does because it's giving me a 10% dividend or something like that, right? And I'm just going to hold that sucker long term. I don't care what the price does because I'm not selling it. That's kind of my approach. It's a longer term approach, but it's all about financial independence. It's all about the options that we talk about and, having your passive income streams be diversified in multiple assets to offset the income that you need to live.
Sure.
It's simply that on paper. Simple, but not easy.
Yeah, absolutely. I can see how even that sort of strategy can make people nervous, right? You hold this asset and then the value's going down, but for you, that doesn't worry you because you're not going to sell it.
You want to know what happened last year in 2020 and in late March and April, if you're talking stocks and whatnot. So let's say that you had a dividend paying REIT, real estate investment trust, or a stock or whatever. Let's say they were giving you a 7% annualized distribution or dividend, right? Well, stocks plummeted, as we all know. They went 30, 40, sometimes 50% on sale. So imagine at that point, whether you're holding or not, that's definitely a buying opportunity, because if the dividend doesn't get cut or removed or stopped, they keep distributing, let's say, the same amount to you, but you're buying the shares at half price. So what happens when it recovers? Your yield just doubled. Now you're making a 14% cash flow. That's pretty solid. You know what I mean? So that's how I see it is you can't time the market. We all know this. It's statistically near impossible to always be right by timing the market. So I'm constantly buying in. My real estate, for example, one strategy I use, so I earn income, I put it into real estate. The real estate gives me cash flow. I turn around and take the cash flow and put it into something like that, a publicly traded REIT, for example. And now that gives me more cash flow. I take that and I put it into something else. I mean, it's this snowball effect, and it can happen quicker than you think, where you get these numbers that you just didn't think that you could ever have.
Yeah, absolutely. So in terms of specifically what you're dealing in multifamily, you were saying, the types of clientele you work with, what exactly is syndication and why is it important?
Yeah. And so this is a bit more of a sophisticated level. So with Ashcroft and with many groups out there in the space that are doing these real estate private placements, or the layman's term is called syndications, what you're doing is you have a general partnership, and then you have limited partners. So the structure is often an LP, limited partnership. So the general partners are the folks, they're going out there and they're finding a property that they're going to purchase. Let's say it's a 400 unit apartment building in Dallas, Texas. Okay. So they would have to come up individually with 20 or $30 million as a down payment and for the rehab budget to purchase this. Well, a lot of people don't have that kind of liquid cash, right? And so they're going to raise the capital from limited partners, which is what I am. So they're going to have, let's just call it 100 or 200 investors who are each putting in, let's say, $50,000 or $100,000 or $25,000 each. And then collectively, we're going to raise that 20 or 30 million. And then we all become equity owners in that apartment building. So I might represent, let's say I put $50,000 into a deal. I might be a 1% owner of that apartment building. And so then we're all sharing in the cash flow, the profits, the equity upside as we rehab it. And when I say we, I'm not doing it. They have professional contractors and teams and property managers. They got the whole deal. And so this is the whole idea about being hands off in real estate. I learned very quickly firsthand, I wasn't very good at rehabs and construction and putting in carpet and painting homes and fixing roofs. I couldn't really do any of it. Maybe paint a wall, maybe sweep a floor. And so, it's just that, again, that diversification piece for a lot of people. Maybe they do have their stocks, bonds, mutual funds, 401ks, et cetera, but maybe they have some extra cash that they want to put to work. And so they might put it in a real estate syndication or something like that. So we're going in and we're fixing it up and rehabbing units and clubhouse and adding amenities and package locker systems and covered carports and dog parks and you name it, depends on what the property needs. And then we're going to sell 3 to 5 years later, typically, to a buyer who has a different business model, which is I want to buy something that doesn't have deferred maintenance and problems, that's occupied with a high occupancy, where the rents are at the market level. They just want to sit on the asset. They just want to park cash and sit. And rightfully so. A lot of these are institutional players, REITs, mutual funds, pension companies, insurance companies, et cetera. So that's kind of how it works, in my world. And I love it. It makes sense to me. It doesn't mean it's right for anybody else. Not a financial advisor or planner for anyone. I'm not suggesting anybody do this stuff. But for me, that was an excellent approach to be in real estate, not have to be hands-on and active with it, and then get, monthly income rolling off of it and participate in the equity upside and get the tax advantages that we all know are great in real estate.
Yeah, absolutely. That's a really, convenient service that you're offering, because a lot of people, they'll say, hey, I would love to have that rental income, but I don't want that call at 3 o'clock in the morning saying the toilet's broken, or I don't want to tear out a wall or whatever it may be. Right.
Termites, tenants, toilets, trash, whatever. Yeah. You hear it all the time. I agree. Hey, I'm with you. Right. But it doesn't have to be that way. A lot of people, including myself in 2009, thought that way. I thought, man, if you want to get in real estate, there's only one way to do it. Buy a single family home and rent it out. And that's all I could wrap my head around until I started surrounding myself with a lot more people doing a lot more things in life. And then I realized, well, wait a second, that kind of makes a lot more sense to me. And so it takes a little self-education and networking.
Sure, absolutely. I'm just curious as well. You kind of mentioned this mindset shift that you had from being solely fixated on single family homes to transitioning to multifamily. Could you kind of maybe talk about maybe the cash flow differences between a single family home versus multiple units?
Yeah, this is an interesting concept and kind of an epiphany for me. So if you put it out on paper, I'm just going to throw out a simple example, not talking about any particular deal or anything like that. But let's say I'm an investor and I say, okay, I could buy a single family home, okay, in my own backyard, so to speak, and I could get a 15% annualized cash flow return. Just making that up. What if I could? Or I could do the syndication deal where I'm hands off. I don't have to really do much at all. And I get a 10% return. Okay. Well, on paper, you'd say, do the single family home. It's a lot better return. But the way I look at that is that 5% margin is you paying yourself for your time and effort. I have to go look for properties. I have to have relationships with realtors or brokers, do my due diligence, put it under contract, market it, put tenants in it. Some tenants are going to destroy it. When you're vacant, you're at 100%, loss, maybe even negative, so there's a lot that's active about this. Okay. And so if you have to put in 100 hours or 200 hours a year into managing that property, that's your 5% margin. So the question is, how much is that 5% representing to you? Let's say it's, I don't know, $3,000. Well, is it worth $3,000 of your time and effort and energy and risk to go do all that? And if it is, that may be your best option. But for me, I'm looking at that going, that's not worth my time. I value my life at this point. When I was working in the oil industry thinking, God, I worked 100 hours this week and I finally have a day off. The last thing I want to do is go look at real estate and go drive properties and be making offers, right back into work the next week. So everybody's different, but that's how I kind of look at that. So it's all over the board, by the way, to get more precise on the question that you asked about returns. Man, I had single family deals I killed it on and did relatively little effort. Okay. And I had deals that, oh my God, I put in 6 months of effort and time and I made pennies. I mean, I made crap on it. And so it really depends. And on the passive stuff, same thing. Some deals just killed it. Right timing, right price, right market, right situation, yada, yada. Other times, man, we struggled. It was falling behind. The cash flow wasn't what we thought. There was a fire in a unit. Oh my God, now it flooded. Now a tornado came through. I mean, things happen. It's real estate, it's people, right? So that's the beauty, though, of being a limited partner like I am, is I can diversify. I've done like 35 of these deals with 14 different operators. So I'm in different states, different markets, different asset types, different business plans. And so I'm diversified. Just because a hurricane wipes out something in Miami or whatever, well, I'm in Colorado too, for example.
Yeah. No, absolutely. You brought up something interesting is, kind of dealing with, Mother Nature, right? Maybe you can't control that tornado, that fire, that hurricane. But, in terms of looking at a deal, what do you think, will make or break you? What'll make a good or a bad deal?
Yeah. So there's 3 areas of risk. You have the team and the sponsorship, the general partner, like we talked about, their ability to execute the business plan, their track record, their experience. So that's the biggest. If I have to put a weight on it, that's 50% of the equation right there. Then you have the market. You want to be in a good market, a growing market, a market where there's lots of jobs and diversified employment and whatnot. Then you have the deal itself. It's got to be a good deal. The numbers have to make sense. It needs to be conservative underwriting and whatnot. So what makes a good deal and a good opportunity is all 3 of those in alignment. But that's a process, So my job as a limited partner is to vet out these 3 areas of risk and make sure I'm taking as little risk as possible for the maximum amount of return, reasonably speaking. But first and foremost, man, working with the right people and the right team. You're making a bet at the end of the day on people and their ability to execute a business plan. That's the biggest thing. You can buy the right property at the right time in the right market, but if they mess everything up, you're not going to make money, or if they don't handle situations and you got foundation issues and mold issues. And it could be really bad. So those are my 3 areas that I look at.
Yeah, no, absolutely. I'm just curious as well. Are there any particular markets, maybe not just in Florida, but just across the country that you tend to gravitate towards?
I think you and I would be in alignment on this. I'm mostly in Texas, with my real estate among a lot of different operators, but San Antonio, Dallas, Fort Worth, I don't know, Lubbock, all over the place. But Florida's a big one for me too. I've spent a lot of time there in my life, more than a decade. So I know a lot of the markets there. Not every market's the same. I can't just say Florida because Miami is not Tampa. That's a totally different situation, the same as, upstate New York and New York City. We're not talking the same language, So, Georgia, I've done deals there, Arizona, Ohio, Michigan, Colorado. A lot of different markets. But what matters, back to the 3 areas of risk, are what is that team's expertise in that particular market? Are they branching into this market for the first time, never done a deal there, don't really know what they're doing? Or is this like, hey, this is our spot. We've done 30 deals here over and over again. We know the market like the back of our hand. This is our territory. That's who I like to invest with, people who specialize in markets.
Absolutely. So to you, I know you mentioned obviously, being confident enough to handle those problems when they come along. But for you, what makes a good team that you think will get a deal done?
Yeah. Well, something that we haven't mentioned yet that's really important is, do you get along with these people? is your philosophy on investing in alignment with theirs? Is your criteria in alignment with what they do? For example, I like value add B and C class multifamily and tax-friendly states with monthly distributions. And I'm just spitballing some criteria. Well, does that team do that? Because if they're doing a new development, new construction in San Francisco, doesn't really cut it, you know? So the first thing is align yourself with people in alignment with your vision too, right? Because again, they're making the decisions on your behalf. And you want to make sure that you're partnered up with someone that would make a similar decision than what you would do, right? So that's the biggest thing. Reputation is big. A lot of these groups, that the way I found them is through word of mouth references, going to conferences, real estate meetup groups, talking to hundreds and hundreds of people and hearing the same names pop up over and over again. Love this group, love this group. I'd stay away from that group, maybe not do a deal with them. And you get the, you know, you read between the lines after a while, you know. And of course you could dig a lot deeper. We're talking high level here. You can go background searches and yada, yada. But, you know, at the end of the day, hop on a Zoom call like this, speak face to face, look them up online, do your due diligence, look at their past performance and track record, ask for some names of their investors. They're probably going to give you their best investors, you know, the ones that are, you know, fans of them, of course, but ask those investors if they know more investors, you know, like keep the ball going. And again, at the end of the day, what are you trying to do? You're just trying to say, is this team really going to execute this business plan? Are they likely going to be able to pull this off? You know, if it's a brand new group doing a really heavy value add or new construction project, that could be dicey. You know what I mean? But if it's a real light value add, they're just going in, we're going to redo the paint and change out the floors and the appliances, you know, yada, yada. And we're going to bump rents $50 a month. I think a lot of groups could probably pull that off, you know, even if they're newer. So it's just trying to read between the lines and decide if you think it's realistic.
Yeah, absolutely. That seems crucial, you know, not just in the multifamily space, but with anything, just making
Yes.
sure that you're on the same page as the other person.
100%. That's the name of the game. You bet.
Absolutely. So, you know, you've done a great job of explaining, you know, what syndication is, but in terms of multifamily, you know, what's a good way for someone maybe getting into it, or maybe they're just starting out with single family homes? How can they kind of get a more comprehensive education on multifamily?
A lot of great resources. Unfortunately, in 2015, when I made the big pivot from single family, there was not near the books, the resources, the mentorship, the conferences. Very little existed, at least in my perspective back then. So today I try to be that mentor for others. I try to be that person who I wish I would have ran into in 2015 to kind of walk me through this stuff like we're doing now. Reach out to me, reach out. There's great books. There's a book that just got put out a few months back, maybe it was last year, I don't know. And it's called The Hands-Off Investor by Brian Burke. And man, that's a dense book. It goes into essentially everything you need to know about passive investing, you know, in real estate syndications, stuff like that goes a long way. Joe Fairless wrote a great book, Joe Fairless of Ashcroft Capital, the Best Ever Apartment Syndication book. That goes over active and passive investing in the space. So whether you want to be a little more hands-on and do a deal yourself, or if you want to be an LP like I am, you know, so those are the best ways. Two things to point out too, just so no one's caught off guard if you go researching this stuff. First of all, you may or may not even want to do this stuff because one, there's a barrier of entry. There's a couple of them, in fact. One is a pretty high minimum investment usually. So like Ashcroft's is 25,000, for example, but a lot of other groups, it'll be 50,000 or 75,000 just to get, you know, into one deal. So make sure that, you know, you've got the liquidity to do that and understand that these are not publicly traded. So if I go put 50,000 in a deal, I can't be calling them up a month later and saying, I actually need that money back. Something came up. No, it's gone for like 5 to 7 years. I'm not getting it. So just recognize that, okay? As compared to like a publicly traded REIT, a real estate investment trust that, you know, I buy shares today, it's publicly traded, and tomorrow I go, oops, I don't really want to be in that one. I sell and I'm out. You know, that's pretty awesome. So pros and cons. The thing I don't like about the stock market though, personally, is the volatility. I don't like to buy into real estate and then overnight I lost 20% of my money. Why?
Yeah.
It didn't make any sense. Did the tenants all move out? No. Did the rent collections not come in? No. They just, the volatility, right? Ups and downs. And I hate it. I can't stomach it. I can never have a big amount in the market for that exact reason. Number two, a lot of these syndications are only available to accredited investors. Make no mistake, a lot are available to sophisticated investors who may not be accredited, but a lot are accredited only, including Ashcroft's deals. So what does that mean? $1 million net worth if you're an individual or a married couple, excluding your primary residence. That's one way to qualify as an accredited investor. Number two is on income. You can qualify by income. If I'm an individual, I had to have made 200,000 or more for the last 2 years with the expectations of meeting the same or exceeding that in the current year. And if I'm married, 300,000 gross income for the last 2 years with expectations of meeting that in the current year. So if you qualify on one of those, there's other ways to qualify too. The SEC, they're opening up the definition now. You can have a Series 7 and 63 license if you're like a broker dealer or something. And you can qualify with certain trust with a certain amount in them. And there's different ways. So look it up. But generally speaking, high net worth, high income individuals. So if you don't meet that criteria, just know that you'll be limited in what deals you can participate in. Doesn't mean you can't, but you'll be limited. So those are the two things to consider with it. When you meet that threshold of accredited, the world's open to you on investing. You can pretty much invest in anything on this planet.
Yeah, absolutely. I mean, that can kind of be, at least for some people, even hearing the words accredited investor, that is a barrier to entry, right?
It is. And it's something to consider. So for example, my nephews, 19 years old, 17 years old, and 17 years old. Okay. They love the path I'm on. They're all about this passive income as well, but they're not accredited. So what are they doing? They're buying high dividend paying REITs and things like that through a brokerage account, with as little as $10 per share. So every time they can go put $100 in their brokerage account, they're buying 10 shares of something with it, and they're getting that cash flow coupon. So back to my original concept about passive investing and passive income, there's different ways. Just because I do multifamily, 80% of my portfolios there doesn't mean that's right for you or anybody else. But there's other ways you can clip a cash flow coupon. So I encourage you to get that self-education, or reach out to me or anybody and figure out what other ways you can do that.
Sure thing. Yeah, absolutely. So, we've talked a bit about, what you've done in the past in terms of your real estate experience, what you're doing right now. What are you looking to do in the future?
I was fortunate in 2015 when I was making this decision to leap into this stuff to have come across a couple mentors that I'm still in touch with pretty frequently, who are in their 60s and 70s as far as their age. And they've done, 150 LP deals, just example, right? I've done 35, they've done 150. They're a lot further down the line than I am. I really admire what they've built, what they've done, what they do. And I want to continue on that same path. So I'm not looking to switch it up and go be a GP now and I'm doing my own deals. I'm not going to do that. I'm going to continue being a limited partner and or a passive investor in these asset classes long-term. And that's my full intention. I want to be these guys. I want to be my mentors, and that's the best way is, just absorb their knowledge, and kind of grow yourself into that. So you got to pair up with the right people. It's all about teams.
Yeah, that's kind of the big message here is just kind of getting with the right people. I mean, you even said, getting with someone who would make a similar decision to you or kind of understand the pace that you go at.
Yes. Yeah, that's of utmost importance, man. It really is. Just imagine if you didn't vet out a sponsor very well, which I didn't in the beginning in a couple deals. And let's say you weren't aligned in philosophy, like you just didn't get along, generally speaking. Well, you go give them $100,000 and now you can't get that money back for 5 to 7 years. You're forced to be in communication with them throughout that time frame. That's a horrible thing.
Yeah.
Who would want that? You know what I mean? That's a horrible situation. It's like being forced with a business partner with a signed contract for 7 years and you have to communicate all the time. That's terrible. So do your due diligence, really think this through, before you're making investments like this. It's not easy to pull out of. You can sell your shares, by the way. I don't want to paint the picture like you're stuck and you can never get out. They're private shares. So there's no public market for them. Okay. So I could come to you if I have shares in this real estate deal and say, hey, Aaron, would you like to buy my shares here? I'll sell them at a $5,000 discount to you. And then you can get in this deal. And we're already two years into the business plan. That may be a good deal for you. And then we could swap places. I get most of my money back. I'm out. I'm done. So you can do this stuff. It's just not as easy as a stock.
Yeah. Yeah. And that's a very nuanced situation, right? It's not, it's not like you would see a rundown house down the street and you would say, hey, I can go flip that, right?
Right. Yeah, exactly. Yep.
Yeah, absolutely, Travis. Well, is there anything that you haven't said thus far that you'd really just like to hammer home?
Man, I really do want to be that person, as I described, that I wish I'd ran into in 2015. Take me up, anybody listening, on that offer, the free 15-minute phone call. It's just done through a Calendly link. You click a time that works for you. We can do a Zoom call, a phone call, whatever works. You can go to ashcroftcapital.com/Travis. And right there's my calendar. There's also a PDF guide on there that's free if you want to download it. It's called Understanding Real Estate Private Placements. It goes into a lot more detail than what we were able to do on this show here, as far as industry terminology, how to vet a deal, a market, a sponsor, common questions to ask a general partner. There's a lot of good content. It's about 20 pages. So check it out, ashcroftcapital.com/Travis, and take me up on that.
Yeah, absolutely. Well said, Travis. Well, I've really enjoyed having you on the show, talking about what you've done in the past, what you're doing now, and the sort of multifamily deals you're looking to do in the future. Well, thanks so much. I appreciate it. Yeah, absolutely, Travis. Yeah, you've been a great guest. I've learned a heck of a lot about multifamily syndication, and you've been a great guest. So thank you. Thanks, Aaron. I appreciate it. Thanks, everyone, for listening. Talk to you later. See ya.